Hey, investors. If you've been dreaming about stacking doors, getting those cash flow checks, and finally stepping into the world of multi units, this one's for you. Today, we're breaking down how investors like you can use DSCR loans, non QM options, and other creative financing tools to build and grow your portfolio. This ain't your mama's 30-year fix. We're talking about financing built for hustlers, entrepreneurs, and anybody who wants more than just one front porch. Quick reality check why this matters. Now, before we dive into loan acronyms, because y'all know mortgage loves its loan acronyms, here's the tea. Traditional mortgages, they're cool, but they're built for people buying a primary residence. Investors like you need flexibility. You don't always have a W-2 income. Maybe tax returns are creative, and you want financing that's based on property more than just your pay stub. That's where DSCR and non-QM loans slide in, like the besties they are. DSCR loans are the investor's BFF. Friends forever. Debt service coverage ratio. I know, sounds like something from a finance textbook, but it's simple. Lenders look at whether the property's rent covers the mortgage. That's it. If the monthly rent is equal or greater than the monthly mortgage payment, including taxes and insurance, then boom, you might qualify. They don't care about your personal income, your W-2, or whether or not you wrote off your business expenses last year. That's why investors love DSCRs. You can qualify based on the deal, not your personal finances. Perfect for multi-units, Airbnbs, or long-term rentals. There's a flexible down payment, usually anywhere from 20 to 25%. Rates are higher than conventional, but you're trading for leverage and opportunity. Why do investors love DSCR? You can qualify based on the deal, not your personal finances. Non-QM loans are for the outside-the-box investors. Non-QM stands for non-qualified mortgages. Basically, it doesn't fit the Fannie Mae and Freddie Mac traditional guidelines. Here's an example. Some examples are bank statement loans. You can use your deposits, not your tax returns, to prove your income. Asset-based loans. Got cash or investments? Those can show as repayment ability. Foreign nationals, or investors that are outside of the U.S., ITN loans for folks without a social security number, but who do file taxes. That's what the non-QM is all about. It's flexibility for entrepreneurs, self-employed investors with unique situations. Is that you? These type of investments help you expand your options when conventionals say nah. Other investor-friendly options include, because why limit yourself? Let's keep the toolbox full. Portfolio loans. Some lenders hold loans in-house and create custom terms. That could be a good thing. That may be another option that works for you. Great. If you want to bundle multiple properties under one relationship, that's cool too. We also do cross-collateral loans. This allows you to use equity from one property and leverage it for another property. Basically, making your money work double. Bridge loans, those are short-term financing, so you can grab property now, then refinance later into long-term. Perfect for when the timing matters. If you're going to do 5 units or more, you're in commercial territory. That's a commercial loan. Terms are different, underwriting is different, but opportunity is big. Here's how you prepare as an investor. Here's how to prep your checklist. Because knowing your loan type is cute, but lenders still need receipts. Cash reserves, make sure you check your credit. You want to try and shoot for 660 or higher. That's the minimum score for a DSCR. You want a higher credit limit for the best terms. Lenders want to see that you can cover 3 to 6 months of payments. Do a property analysis. Know your rent estimates, expenses, and cash flow numbers. Have a game plan. Are you holding long term? Flipping? You doing Airbnb? Have your strategy ready so that lenders can take you seriously. Also, team up with a solid realtor, a good mortgage pro like myself, and maybe even a property manager. Don't try to wing it solo. We're a team. We can help you. You also want to know the risks versus reality. Now, let's keep it 100. DSCR and non-QM loans often come with higher interest rates and fees. That's why the trade-off is for flexibility. If rents dip or vacancies rise and your DSCR ratio can get shaky, always run the conservative numbers. On the non-QM programs, things change quickly. What's available today may not be available tomorrow. So don't over leverage. Think long-term. Sustainability. Think big picture. At the end of the day, let the property qualify for itself. If you're using non-QM, flexibility when conventional says no. Other creative tools include keeping your options open so that you can scale faster. Smart investors Use these loans to build wealth, not just buy houses. All right, squad, so let's wrap it up. If you're sitting on the sidelines waiting for the perfect rates, stop it. Rates might shift, but opportunities don't wait. The real move, get educated on the DSCR loan, non-QM, and creative financing so that you can pounce when the deals come. Drop in the comments, are you team long-term, team Airbnb, or team multi-units? I want to see y'all where y'all heads are at. I want to see what you guys are doing. And if this video helped you, you took some notes, send it to your investor friends. Send it to your homies, your friends, your girlfriend. If you feel that it can help someone else grab their first deal or their next building. I'm here to help you. Let's be a team. I want you, do me a favor, follow, like, subscribe, all of that. I'll be back breaking down more investor tips so you can grow your portfolio without losing your mind. Peace, love, and profitable properties. And profitable, extra profitable properties. Because why limit yourself? Let's keep the toolbox full.